Amazing. All right. Hello, hello, everyone. My name is Rachel. I'm excited to chat with you today about building financial stability in Canada. And of course, joining me today is Sajedeh Eskandari, a senior financial advisor at Scotiabank. Now, Saji works closely with newcomers, international students, and families from all kinds of backgrounds. And so she really understands the financial side of settling into life in Canada. And so, Saji, welcome. And maybe you could tell everyone a little bit more about yourself and what you do.
Thank you, Rachel. So, as Rachel mentioned, my name is Sajedeh Eskandari. Most people call me Saji. I'm a senior financial advisor at the Scotiabank in Toronto, and I spent several years working in financial services. A big part of my work is helping newcomers, international students, and families from diverse cultural and professional background navigating the Canadian financial system. I understand that moving to a new country comes with so many challenges, especially when it comes to banking, credit, employment transitions, and financial planning. So I'm here to share what I've learned and help you to simple this path for you.
Awesome. Thank you, Saji. Now, Saji, I'm not sure if it's just on my end, but you're a little bit frozen on my screen. Is it all right if you can maybe refresh your video? There. Now you're moving. Perfect. I think now it's good.
Now it's good.
Uh,
Okay.
Working in the age of the internet, I know it's like, but I mean, this is the way we reach people from all parts of the world.
I
And
see.
speaking of, we have a lot of people tuning in right now, so I just want to give a quick shout out to people on the live. Thank you everyone for joining in. So we have everyone. I'm gonna be butchering some of the usernames here, so I'm so sorry if I can't pronounce it, but hopefully, um, you know that you're seen, and it's good to have you guys here. Hi from London, from Morocco, from Nigeria. So it's always great to see where our audience is tuning in from. And of course, as we welcome more people into the live stream, for anyone in the chat, do let us know, drop the city or the country that you're tuning in from. It's always great to see where our audience is at. But that said, today's session is all about, again, building financial stability in Canada. And, I would say that a huge chunk of our audience are those that are in the stages of moving here quite soon. But regardless, this topic in itself is for a general audience. So whether you just landed in Canada, maybe you've been here for a few years, or you're figuring out, or you're just generally someone who wants to have a better grasp of the money side of things, this session is for you. And very quickly, I just want to cover our agenda today, just so we have an idea of what we'll be covering. So first, I will be talking about the difference between surviving versus thriving financially in Canada. And then we're going to break down all the practical tips. I really like this part because we're basically looking at the financial milestones, I would say, that maybe is worth looking into or considering at a certain stage of your journey in Canada. So whether that's in the first 6 months, first 6 to 12 months, even if you're in the year one mark and beyond. And in between this discussion, we'll weave into certain things like banking, credit cards, savings, and investment accounts like TFSAs, RSPs, FHSAs. I know that those are like a bunch of letters just thrown out to you, but we will be defining them, and Saji will be helping me out and um, defining those terms, as well as like identifying ways to build good financial habits. And of course, just as a reminder, we'll open up the floor to also your live Q&A or live questions. So where Saji and I, or mainly Saji, will be answering them as best as she can. Um, and yeah, I guess we can move on with the discussion. Also, just want to give a quick shout out. We have people tuning in from Montreal. Oh, yeah, Paul, thanks for identifying yourself. Paul, Mauritius, someone from Mauritius here. But yeah, it's always good to see our audience engaged. Um, I also just want to dive into the other nitty gritty, um, starting with I guess, the disclaimer. In short, today's session is really meant to be informative, educational, and basically the insights that we're sharing are general in nature and aren't personalized financial advice. And next, moving on to that is a just a quick overview of Scotiabank Start Right program. So, um, again, this session is brought to you for free with because of our trusted partner, Scotiabank, and one of their and they offer the Start Right program, which is a newcomer focused banking program. So if you're looking to get set up and maybe start off on the right foot financially in Canada, this is definitely worth checking out. In fact, I have a little QR code that if you're watching from your computer, you can take a screenshot of it or even like pull up your phone and take a quick snap and it will redirect you to the website where you can learn more details about the Scotiabank Start Right program. Perfect. Um, I guess we'll get into the meats and potatoes of things now. So let's just start off with the first point, Saji, on survival versus thriving mode. Uh, Saji, how would you describe someone who is like in financial survival mode? Are there common patterns or signals that you tend to see?
Um, in my experience, someone in financial survival mode is usually focused on getting through the month. Most of their energy goes towards paying rent, groceries, and basic bills, with little or no room for saving or long-term planning. Common patterns I see include living paycheck to paycheck, relying heavily on credit cards for emergencies, and feeling stressed or are uncertain about money. Many people in survival mode don't fully understand their expenses very well, or they don't know their credit score, or financial options yet. And that's very common between newcomers. This isn't about poor decision making. It's often about adjustment and lack of information. My role as an advisor is to help clients move from survival to stability by building awareness, control, and a realistic plan over time. They can start planning ahead instead of just reacting.
For sure. That's great. And before that, Saji, I don't know if it's my internet, but I'm seeing you frozen on the screen. So sorry to cut you off there, but is it
Is
all
it
right?
still freezing?
Yeah, is it all right if you can try to hop on the video again and see how that works?
Sure.
Sorry, guys, technical difficulties, unavoidable. Um, but we have a lot of like interesting content or like topics that we really want to discuss. So hopefully our internet cooperates here. Uh,
Okay. I'm here.
you're here now. That's great to see. Yeah, if you can, I guess let's see if how that goes. So
Sure.
thank you for touching on the survival mode. Maybe on the flip side, what does it look like when someone is thriving financially? Can you speak on that?
Okay. Yeah, for sure. When someone start to thrive financially, the biggest change I see is like a shift from reacting to money problems to planning ahead. They have clear understanding of their income and expenses, and they're no longer worried about, like, for example, everyday expenses or unexpected costs. They are having some savings set aside, using credit intentionally rather than out of necessity, and reacting like and I'm sorry, actively building their credit score. Um, they start with, like, for example, setting aside short um, for their short or long term goals. They put some funds aside for it. Could be, the goals could be education, buying a new car, planning for a home ownership.
Right.
Most importantly, thriving financially doesn't mean being wealthy. It means feeling in control and confident and informed about your money. For newcomers, this often happens once they understand the Canadian financial system and begin making a small, consistent decisions that support their future.
Right. No, those are very helpful stuff. And honestly, when you were talking about it, I was having a bit of a mental checklist going on. Um, but sorry, I'm a little bit distracted right now because I think people on the live are saying that you're frozen again. But
It's only
I'm,
it's,
are
I'm
you,
not
I mean,
sure.
I'm seeing you right now. So that's good to
That's
hear.
good.
But
Okay,
yeah,
okay.
uh, it could also be just the connection in terms of the camera, but hopefully uh, seems like you're not frozen on my end right now, but okay. Let's I guess move along. But yeah, as you were mentioning certain points in survival versus thriving mode, I had a bit of a mental checklist going on, like, oh, I've done that. I was once there. I still need to work on that one. And so I think, I see parts of myself in both sides. And I guess for a lot of people, not just myself, I think this is such a helpful exercise of having like an awareness check. And with that, like Saji, like maybe another question I have is like, once someone recognizes that they're in survival mode, what's usually the first financial shift that you encourage them to focus on?
The first shift when someone realizes they are in survival mode, I encourage is moving from reacting to expenses to getting clarity and control over their money. That usually starts with understanding where their money is actually going, like income, fixed expenses, and variable spending. Once they see the full picture, we focus on creating a simple budget and identifying even a small amount to save, no matter how modest or how much they can save. At the same time, we talk about using credit more intentionally and avoiding high interest debt where possible. This first step isn't about big changes, it's about building awareness and a small, consistent habit. That sense of control is often what helps people move out of survival mode and start progressing toward financial stability.
Perfect. And like, how long does it usually take before newcomers start to feel settled? Like, I know that you've talked to a lot of like students, maybe newcomer families, like, based on your conversations with them, how long does it take for them to feel settled or see progress financially when they're here?
Yeah, it's really depends. From my experience, most newcomers begin to feel more financially settled within their 6 to 18 months in Canada. Um, Although it really depends on individual circumstances, like, for example, employment, family situation, and overall financial awareness. The first few months are usually the most challenging. People are adjusting to a new country, new expenses, and different financial system. Once they secure a stable income, start building their credit history and understand how banking works here, they usually begin to see progress. Financial stability doesn't happen overnight, but
Mhm.
with the right guidance and consistent habit, most newcomers steadily move towards feeling more confident and in control in
For
6 to 18 months. Yeah.
Yeah, perfectly said. And you know what? Like that's exactly what I guess the rest of our discussion is about because these things take time and but it's also good to know what those practical steps look like. And so if we were move on, this is pretty much the chunk of our discussion for those of you seeing our deck here. Um, we're pretty much going to break down the next part into like three buckets so that you guys can imagine maybe certain things that you might want to be aware of in your financial journey, not just your general journey in Canada. And it's great that we put it in buckets, like for your first 6 months, your 6 to 12 months, and even for those that are in their 1 year and beyond. So I guess we could just dive into it. So Saji, if you could help me out here. I know that when you first arrive in Canada, right, one of the very first things that you'll need to do is open a bank account. So, what should someone who's new to Canada focus on when choosing their first one?
Very good question, Rachel. When choosing their first bank account, newcomers should focus on simplicity, affordability, and support. First, it's important to look for a newcomer or a student banking package that offers low or no monthly fee and like includes everyday features like unlimited transaction, online banking, and debit access. And these accounts designed especially for people who are new to Canada. And second, I can say access matters. Choosing a bank with convenient branch location, ATMs, and strong digital banking tools makes their work easier. And finally, I always encourage newcomers to consider the guidance and education available. Like right now that you provide this good program for newcomers, a bank that takes time to explain how accounts, credit, and savings work can make a big difference in helping someone like building a strong financial foundation during their first few months in Canada.
Right. Actually, like now that you mention it, like um, I like being a newcomer, like but maybe years back, but the access, like I usually find like at least in our home country, like talking to an advisor seems more like something that um, is not as accessible. So I was quite surprised that when I first landed as an international student and I was opening a bank account, that they welcomed me to their office and like, okay, like welcome, like let's kind of brief you in on the things that you need to do to get started. And it really felt like a good like welcoming party to life
Exactly.
in Canada. And I really like that they took the time to explain certain concepts to me, especially when I first came here. I was like 23 years old and I was still navigating finances in general. So it seemed
Yeah.
like everything seemed daunting and all the questions that I had, I wasn't really sure if they were silly or if they were like, oh, I don't really know what I'm maybe asking or I don't know what to ask. But the convenience of most Canadian banks is that you can
I'm
have
happy that
access to
you
funds
have good experience.
for sure. And on my next question, I guess like what kinds of accounts do you usually see newcomers opening in their first few months?
Um, Typically, it's a start with a checking account, and that's your everyday account for paying bills,
Mhm.
receiving your paycheck, and handling day-to-day spending. A saving account, on the other hand, it's meant for setting money aside. It's where you keep funds you don't need to spend. And like, for example, for emergency saving or short-term goals. Saving accounts usually earn interest here, but they are not meant for regular daily spending. So they are just for saving. Having both of these accounts help client to um, build healthier financial habits.
Gotcha. So I guess like checking accounts are more for daily spending or money that you need access to right away. Savings are more for like short term or longer term goals that earn interest. That's good to know. Um, like assuming I were new to Canada again, like are there any documents that someone should have prepared to bring with them when they visit, for example, a Scotiabank branch?
Yeah, for sure. To open bank account in Canada, newcomers typically need two forms of identification. One is usually a government issued photo ID, like passport. The second document confirms their status in Canada, which could be study permit, work permit, permanent resident card, or confirmation of permanent residence. In some cases, banks may ask them the proof of address or social insurance number, which we call it SIN as well, SIN number, especially if the account earns interest. We need SIN number. But SIN is not required just to open a basic checking account. The best advice I can give to newcomers is to bring all immigration documents that they have, so the process is smooth and quick.
For sure. I like that you mentioned that because I like when I'm looking back on my own experience, I think right when I landed in in YVR airport, my family or my relatives picked me up. We definitely had like a okay, you gotta get your okay, you got your study permit check. Okay, now we're gonna go to get your SIN, and then I think I was able to get all my documents that I need, and then on the same day open a bank account. So
That's good.
just because I had those already with me, so we might as well just hit multiple birds with one stone. So I mean, for those of you that are planning to move to Canada, that could be something that you want to perhaps do in your first week at least. But if you're ambitious like me, maybe you can even get it done in on your day one in Canada.
Yeah.
Um, but speaking of like, I know that a lot of banks offer newcomer specific packages. So Saji, like for someone who's just arrived, like what should they actually be looking for in those packages? Like I know that just says like, okay, newcomers, but what makes it one worth it over the other accounts available?
That's a great question. When looking at newcomers, specific banking packages, I usually encourage newcomer to focus on long-term value, not just the sign-up offer. Pay attention to monthly fee waiver or fee banking, or like, for example, some of the banks are free for the first year or longer because that can significantly reduce cost while you're settling in. Also, look at what's include like unlimited transaction, free Interac e-transfer, and easy access to digital banking. Many newcomers packages also include help with building credit, like access to a credit card without an extensive credit history, and consider additional support such as financial advice, saving options, and newcomer education. The real benefit is a package that helps you manage daily banking, build credit, and grow financially with confidence during your first month in Canada. And yeah, in the newcomer package, should be always like a credit card as well, because it can help newcomer to build their credit as soon as they get to Canada.
For sure. And actually, again, that's a great segue. For those of you watching, the Scotiabank Start Right program is designed specifically with newcomers in mind. So if you're also in the early stages and you're looking for a place to start, it's worth checking out. And again, I'll just be sharing quickly the QR code on your screen. But thank you so much for those details. I guess we can move on to the next point, which is like about online banking. Let's just quickly touch on this. Can you walk us through the benefits of using mobile or online banking?
Absolutely. When newcomers start using online or mobile banking, um, they gain access to many everyday features that makes managing money much easier. Some of the most helpful tools include checking account balances in real time. You can like check how much you have in the account, tracking recent transactions, and setting up alerts to monitor spending and payments. In transfer are widely used in Canada and allow people to send money, receive money quickly without using cash or checks. Um, Online banking also makes it easy to pay bills, such as rent and utilities, set up automatic payments, and move money between checking and saving accounts. Many apps also offer budgeting tools and spending summaries, which help newcomer understand where their money is going. Overall, online banking and mobile banking give newcomers convenience, control, and confidence to track their spending. And actually, Scotia mobile banking has this feature which you can see, and it's actually track your cash flow and let you know how much you spend, where you spend, and it's really helpful for budgeting.
Per- Perfect. I'm glad that, yeah, the convenience of just being able to pay your bills from your phone is amazing. I think that was one of the first few things I found cool back when I was starting. I like depositing a check and just being able to scan it and then
Yeah,
right to my account, but also pay bills online.
exactly.
It just removes the hassle of like physically going to a location to get that done. Um, and with that, like I know that online banking is quite secure, but also just as a precaution, what should newcomers be aware of so that they can protect themselves? Because I know that like some being new as well, you don't know whether it's um, what's fishy or not, what could be.
Yeah.
So what would you say? Um,
Actually, like that's a big one. One of the most common scams is like fake messages or phone calls that appear to come from a bank, CRA, or even a delivery company asking for personal information, password, or one time verification codes. Banks will never ask for this information by text or email. Another red flag is being pressured to act immediately, such as like for example messages that saying your account will be closed, or like for example you owe this much money unless you respond right away. Something like that. Scammers often use urgency to create panic. Newcomers should also be cautious of unexpected e-transfers, job offers that are ask for upfront payments, or links that ask them to log into their bank account. Um, when in doubt, I recommend it's best to stop. Don't click and contact your bank directly using official contact information, and always use a strong unique password for your bank application or your online banking. and also turn on two-factor authentication, which is really helpful. And try to avoid doing your banking on public Wi-Fi.
Very good. Like those are very helpful tips, and yeah, I've come across them myself, and it's just good to be aware of what to spot what those dangers are so that you don't fall into those traps. So very well said. So with that, I guess we can move on to the next portion, which is an interesting one. It's all about credit cards. So Saji, what does it make, or so rather, when does it make sense for someone to consider getting their first credit card? Because I remember, I think it took me like perhaps I was in the 6 to 12 month mark before I even considered it. But um, what's generally a good time for one?
Um, I can say, like, for most newcomers, it usually makes sense to consider first credit card as soon as they have a stable bank account and regular income, even within the first few months in Canada. Many banks offer newcomer credit cards while they are opening without existing credit history, or they can secure a small amount as a deposit and then get a credit card same amount that they deposit or they secure, which called secured credit card. The key is to think of it as a tool, not a trap. Sometimes, like my client doesn't like credit card because they thought that it's debt. But if you use it for small everyday purchases and pay it off in full each month, you're building your credit without paying any extra cent for interest.
For sure. And is there a type of, I know that you mentioned secured credit cards, but are there other types of credit cards that you would recommend starting with?
I recommend to keep it simple. Look for no annual fee card. Like you don't need a fancy rewards card right out of the gate. A basic card with no fee, a reasonable credit limit, and maybe some cashback or small points on everyday purchase is a great place to start. Like if a newcomer doesn't qualify right away, a secure credit card is another good option. This type of credit cards is backed by a small deposit, as I mentioned, but it helps build credit in the same way as a regular credit card.
For sure. So, yeah, so for a secured credit card, there's a small deposit that you would have to pay upfront, and then that would also be your credit limit, I'm guessing.
Exactly. It's going to be a credit limit equal to the deposit, but the deposit will be sitting in the GIC, which is an investment or guaranteed investment. And then whenever you want to close or you build your credit, you can take out that deposit.
Amazing. Perfect. Now, on our last point here on this on the first bucket, let's talk about tracking monthly expenses. So, Saj, why is it especially important in your first few months in Canada to do this?
It's really important because everything is new for newcomers, from rent, transportation to groceries, phone plans, and insurance. Everything is new. And many newcomers underestimate how quickly small expenses can add up. In the beginning, income may be limited or still changing, so knowing exactly where your money is going helps prevent overspending and financial stress for you. In the beginning, income may be limited or still changing. So start by just looking at where your money is going, or like for example, pull up your last month of bank account statement or credit card statement, Um, you can see um, like the spending, where you spend, and how much you pay for grocery, rent, transportation, or eating out. Another helpful habit is checking your bank account regularly. Like it could be daily, weekly, um, to be aware of spending. Instead, just wait for the end of the month to see how much you spend or how much you have to pay back to your credit card. When understands their spending patterns, then they can start for small savings, because it's easier to understand the cash flow.
Right. And I'm assuming the Scotiabank has something that
Yes,
helps
yes.
manages. Is that correct?
Yes, we have it in our application, in mobile application, and under the Advice Plus, we have great tools. Budgeting is one of that, which you can use it for budgeting, and it's automatically track your spending and your cash flow, the incoming cash and outgoing, and then it gives you, like for example, if you have any surplus to save, or if you have shortfall, that you have to think and look to your expenses to see where you can save, to not to have shortfall.
No, that's very helpful. I think, like the manual way of having an Excel sheet and then just tracking what goes in and out. I mean, that's also helpful as well if you want to do it yourself, but especially if you are managing it through one account and you want to fast track, like regularly, like checking in with how your finances are doing, that's definitely good to know that most banks are including tools like this to streamline the
Exactly.
process. Um, by the way, for the folks watching here, I did want to highlight, just like reading through our feed right now. Um, and we'll definitely get into these questions more on later. But just as a heads up, if you guys have any questions about some of the points that we're discussing right now, I mean, fun topics like credit cards, or um, I know that we're just diving into the logistics side of things, but if any questions come up, just feel free to drop it in the chat. We will have a dedicated live Q&A later, and we'll um, try to strike them through. But yeah, it's definitely just um, don't be shy to ask your questions the same way that I was shy before asking mine. But all right. With that, I think we can move on to the second bucket, which is the 6 to 12 months. The first point here is all about automating savings. So, Saji, what does that mean? And why is it helpful?
Okay, like automated saving means setting up your account, so a small amount of money is automatically moved into saving from your checking, for example, to your saving, which often you can set it up the same day as your pay, without you having to think about it. You see that you can easily save even a small amount. It's helpful, and it's consistent, so it's a good way of saving money. Like as I said, even a small amount add up over time. It's And since the money is set aside right away, and there's less tempting to spend it. For newcomers, automated savings help build an emergency fund and creates strong financial habits early on.
For sure. So, yeah, that's good. Like, so once you set that up, like it just automatically pulls it from your checkings to a savings account, or it could be your emergency fund. But then my next question is like, is there a big or small amount that you can start with? Is there a recommended amount that you can start with?
For newcomers who feel they don't have much extra money, And the reality is, you can start very small, even $10, $20 at a time. What matters here is building the habit, not the amount. For now, it doesn't matter. Starting small makes savings realistic and sustainable, especially in the early month. As income becomes more stable and expenses are clear, that amount can gradually increase. The goal is
Right.
progress, not like perfection. A small, consistent savings create confidence and lead to strong financial stability over time.
For sure. And I definitely resonated when you said like when you automate your savings and then you don't see that money, it kind of trains my mind to think like, okay, I don't have money to play around, but then I know it's tucked away somewhere where it's earning interest, for example. Um, and it's kind of like a good discipline where, because I feel like
Exactly.
if I see a big number right away, I'm like, oh, I have some leeway. But tucking it away and making sure that I don't put all my eggs in one basket is
True.
perhaps even good discipline for, or good practice for just someone that wants to get control of their finances.
Definitely. Yeah.
And with that, like you mentioned emergency funds. What is it for? I mean, I know that we have a general idea of what it's for, but how is that especially important for someone that's navigating
Uh, yeah. An
the cash?
emergency fund is money that you set aside for unexpected expenses, such as medical costs, job loss, urgent travel, or sudden repair. It's not meant for everyday spending. For newcomers, an emergency fund is especially important because the first month in Canada can be unpredictable. Having even a small buffer reduces the stress and, of course, helping to avoid relying on credit cards or high interest debt when something like unexpected happens. An emergency fund provides a special, like for example, um, a peace of mind, allowing newcomers to handle surprises without falling back into financial survival mode.
For sure. And is there, again, like a recommended amount to start with when building out an emergency fund?
For newcomers, a realistic starting goal is maybe 1 month of essential expenses, such as like their rent, groceries, and like transportation. In the beginning, even having 500, 1,000 set aside can make a big difference and help cover unexpected costs without relying on credit. Over time, as income becomes more stable, that fund can gradually like grow towards 3 months of expenses. And the key is to start small, stay consistent, and build it step by step. And this is where automating your savings really ties in. If you're putting even a small amount aside consistently, you're building the fund without even thinking about it.
Right. I like how it's a full circle moment here. And even like our next point here on building credit habits. We talked about like your first credit card. Now it's about the credit habits. So why is this an important thing to build on? Like why is building good credit important in Canada?
Like strong credit profile can help newcomer rent an apartment, qualify for cell phone plan, finance a car, or eventually apply for a mortgage, which is loan for buying a property. Um, Good credit also allows access to lower interest rates, which means paying less money over time. For newcomers, building credit early by using credit card responsibly and paying bills on time makes it much easier to settle, grow, and take advantage of opportunity in Canada. Credit score is very important in Canada.
Right. And that's something that was foreign to me upon coming here. I think I came with a mindset of like credit cards were like something to for much later when I have a full-time job or when I like later on into my career, because I think from back home we were taught like don't spend money that you don't have, and a credit card kind of gives that temptation. But then you're right to say that it's not about the credit card. It is a tool and it's about the discipline.
Exactly.
But more so now I have a better understanding of like how important it is to build credit habits, because I mean, even starting with your credit card, that builds a good credit history, and then it also opens up so many other like opportunities of like I think for one for me like the even in signing up for a phone plan,
True.
you need to have a good credit history or at least some history. Um, Eventually, like when sending out rental applications, um, the your landlord or tenant or yeah your landlord would be asking that. It's basically building trust that are you able to um, welcome the financial like these finances your way. And it
Yes.
hinges on having a good credit habit. So I didn't know that, and so it's just good
Mhm.
to see all this full circle, how automating savings, how building an emergency fund kind of tie in together. um, But my other question is like when newcomers arrive, do they even have a Canadian credit score? Do they actually start from zero, or um, how is it that you establish good?
Yeah, no, they don't have um, a Canadian credit score, and credit history doesn't transfer from other countries if they live in country that it's matter there. It's not transferable, even if they have a strong credit score back home. Your Canadian credit score, only starts to build once you open a credit products in Canada. Your checking account, your credit card account, and also any bill payment that it's on your name. It's helping you to build the credit, and you have to make sure that you use it responsibly over time. That's why many banks offer newcomers credit cards to help people start building credit from the beginning. The good news is that with regular use and on-time payment, newcomers can begin building a solid credit history within their first year in Canada.
Amazing, perfect. Thanks for explaining that. And I guess we can move on to the last bucket here. I think these are more where a lot of like people are starting to shift from getting settled to actually building their finances. So the first topic here is on the TFSA. Um, the next 3 points seem like just random letters up in the screen here. So, Asaji, can you start with what a TFSA is and what is it used for?
Sure. TFSA stands for Tax Free Saving Account. It's registered account in Canada that allows you to save or invest money and earn growth without paying tax on that growth, or when you withdraw the money. So you don't pay any tax for the growth or when you withdraw the money out of the account. TFSA funds can be used for any purpose. Could be emergency, education, travel, vacation, or saving for a future goal, which could be long-term goal. Um, you can also withdraw money at any time without any penalty.
Right. And um, can, like, for example, like a student on a study permit be able to open one?
Yes, tax-free is for resident. Mm, um, the main benefit is to that like they can actually anyone who resident in Canada and they aim to stay in Canada for 6 months or more, then they can have the contribution room for that year.
Right. And like, how does someone new to Canada benefit from opening one?
Um, the main benefit is that your contribution room start accumulating from the year you become a Canadian tax resident.
Mhm.
So the sooner you open one and start contributing, the sooner you're taking advantage of that tax-free growth. Even if you can only put in a small amount to start, it's worth getting it going and have it to open it.
For sure. And in terms of, and how is that any different from the second point, like the RRSP? First,
Mhm.
let's define it first, I guess.
Yeah.
Is it, and how does it work?
Sure. An RRSP account or registered retirement saving plan is typically for people who are earning income in Canada and planning for long term savings, especially retirement as its name. The big difference from TFSA to RRSP is that RRSP contributions are tax deductible. What that means when you put money in the account, it reduces your taxable income for that year because you have to pay tax on your income in Canada. So if you're in higher tax bracket, means your pay is high. That can be a nice benefit because contributions can reduce taxes. Um, for that year and will tax you later, usually at a lower rate in retirement. The trade-off is that when you eventually withdraw the money, typically in retirement, you'll pay tax on it at that time, which when you retire, your income is not the same as when you are working or you're young. It's most useful for individual in high tax bracket, as I said, and those who expect to earn more as their career grow.
For sure. Now, the thing, well, like my first thought, like, because it's RSP, retired, registered retirement savings plan, the term retirement seems so far away. And then maybe for someone new, is that something that they should prioritize in the near future? Is that something more for later? Um, like for example, between the TFSA and RSP, what would I prioritize more if I only had limited like funds to allocate um, a budget for those accounts?
Um, like you should have stable income to start RRSP contribution. Even like without having any income here, you cannot open an RRSP. I recommend if it's short-term plan and if you don't have much income, then first start with tax-free saving account. And whenever you understand well about these two accounts and you're thinking about saving for long term, RRSP it's better option to save. But again, like you're gonna when you all live in Canada, you will see that both account it's very helpful and you for sure need both of that in the future.
For sure. And I guess like let's introduce a third concept and see how that is thrown into the mix. FHSA, what is it? Can you define what it is and how does it work? And it
Sure.
seems like a blend of both, right?
Yeah. FHSA or First Home Saving Account is another registered account in Canada designed specifically for those who wants to buy their first home. It combines best features of both TFSA and RRSP. Uh, Contributions are tax deductible, like RRSP, and your withdrawal is tax free, same as TFSA.
Mhm.
Like, but only if you want to buy, like you can withdraw for the home purchase. If it's for any other reason, then you have to pay the tax. You can contribute 8,000 every year, with for the whole years that you can have, you can only contribute 40,000 in this account. And the contribution room start the year you open this account. And even if you don't contribute for that year, it's accumulated for the next years, that you can contribute a lump sum. This account will be active for 15 years, and after 15 years, if you don't buy the property, then it transfer or switch to RRSP. Another important point is like timing. Unlike RRSP or FHSA, contribution must be made by December or end of the year. RRSP always you can do the first 60 days of the new year, you can still contribute for the last year income. But FHSA, it's calendar year, so January to December. Um, if you understand these limits and deadlines, helps you to plan for the properly planning and avoid missed opportunities.
For sure. So if I understand it correctly, um, so just a recap: first home savings account. It's meant really just to purchase your first home. It works similarly like your registered retirement savings plan, where you the money that you contribute is tax deductible. Um, and then again, like there is like a timeline for it. Like I'm definitely the reason I'm so invested in this too is because I'm trying to gear up for that next phase. And obviously I want to be aware that okay, there's all these like limits, contribution limits, there's these like deadlines to be aware of. And I also want to see like how I would manage finances if I were to use those three in rotation, after once I have a like stable finances or like a full-time job, for example. But it's also great to see that you can even start um, with less. Like I was always under the notion
Exactly.
that it's not something to prioritize until maybe you're making a certain amount. But um, today's discussion kind of unfolded, and it's comforting to know that any small amount is a good habit to start with. But yeah,
For sure.
um, so thank you so much for that great discussion. And might I say we're quite on time. So yeah, again, thank you for breaking down everything so clearly. I think we can take a breather and maybe move on to the live Q&A segment. I did see a couple questions
Sure.
that our audience has asked, so let's go through it right now. But before that, I also just wanted to share this slide. Um, Everything that Saji has gone over was neatly summarized here. So just if you want to take a screenshot, folks, just for your own reference later on, feel free to do so. But yeah, it's all about TFSAs, RSPs, FHSAs, and credit basics. Um, for sure. Now we can move on to answering some questions from the live stream. I know that I haven't really taken a look at it yet, but there is this one question I saw earlier from Red Styla here regarding credit cards.
Hmm.
I'm back in my home country, but I still have a Canadian bank or credit cards. Can I build my Canadian credit file from abroad by using the credit card abroad? Not sure if that.
Yes, as long as you're using the credit card and paying on time, it's still active and you're building the credit. Yes.
for sure. And then another one here. We see other questions come in. Yeah, feel free to ask folks. Like I know that with like, especially with finances, for me my hesitation was like, okay, I don't want to sound like I don't know, but sometimes like there's questions that you ask that like you you
Yeah.
didn't know that
R-
was something that someone else was curious about. So feel free to find that. Just
Rachel, I also want to add the points that because credit card is always a big subject for newcomers. I just want to say, as you mentioned, don't look at it as a debt. And usually for newcomers, the limit is only 1,000, especially when it's no credit history or like they are a student. If they come with a job offer, it could be like, for example, a Scotia could offer up to 15,000. But I'm saying like as long as you are just having one or two transaction, doesn't matter how much, it could be small. But one thing that you should always remember is spending only 30 to maximum 40% of your limit every month and pay it off. It helps you to build your credit faster. Instead, like some people maybe use maximum the 1,000 or more than 40%, 50% of their limit. This one, it's one of the point that we always mm, uh, like give, tell the client to make sure that they are using only 30% to maximum 40% of their credit card.
right. So for example, if I have a credit card and my credit limit is 1,000, it's ideal or perhaps recommended to utilize only 30% of that,
Exactly.
just as part of building the good credit habit.
Exactly.
I guess my other, maybe the follow up question is that would it be, now I'm caught between like, should I have a bigger credit limit as someone new or,
Very good question, Rachel, actually. Because when you get the credit card, maybe down the road you will receive like limit increase offer, something like that. This is not, don't look at it as a sales point. This is actually good because when you have the higher limit, then you have like you can easily spend the 30% or even less. Like you don't need to exactly go and spend all the money, but when you have higher limit, then the utilization is going to be less compared to
right,
when you have lower limit.
right, that's fair. We also have another question here. I find budgeting really hard to keep as a habit. So, what habits or tools can make expense tracking easier?
Okay, very good question. I do agree. I have like during these all years experience, I can see clients that they have good income, but they always struggle with their finances. And when I ask about like their cash flow, they don't know anything because they never sit and look at their spending. Maybe for 1 month, 2 months, you have to track your spending. It doesn't mean that, like for example, you go to buy something if you buy or no. It means that like first of all, you aware where you are spending, and also like for example every month look at your statement when you come to Canada, or maybe some of you are already in Canada. Many things is like subscribe to some applications, some I don't know, you will see like you pay without you like remember it, or like for example even you need it. So you have to always track your spending by a statement, look at your statement. And also as I said, in the application under the advice plus, you can find money finder tools or budgeting tools. that it shows you for every month where you spend, how much you had money income to your account, or it go out from your account. So it's really clear, and you can use that digital tools.
Amazing. And I think they also have another follow-up question here. If I automate my savings, is it easy to stop and start again? Like, what if I need that money 1 month for extra expenses?
Of course, yeah. If it's like through the application and it's just from checking to regular savings, you can cancel it yourself. But in the future, like as we talk about tax-free saving account, RRSP, you can also do automated deposit or contribution to those accounts every month, bi-weekly, which in case you want to cancel it or just pause it for some month, you can call your advisor or visit a branch and cancel those. But for regular saving, yes, you can easily stop it by yourself through your mobile banking and online banking.
For sure. So there's at least some flexibility in like
Exactly.
having if anything changes. So that's good
Yes.
to know. Another question we see here is that how do I choose between putting extra cash in my emergency fund versus like a RSP TFSA? Because I
Really.
mean they're all kind of like savings and investment accounts, right?
Mhm.
So how do we that seems like a fair question.
Perfect. That's a really good question. Um, in financial planning, we always first start with emergency funds. So you have to first put aside some emergency. If a client have a lump sum and then they want to decide what they should do with this money, and they ask me as a financial advisor to how I can help them, um, by asking questions, I can tell them that, for example, put aside this much in your regular saving account or short-term investment or flexible investment like cashable GIC, something like that, that it's easy to withdraw if you need. While like if you don't need it, it's still accumulating some interest. So first, emergency, and then based on your income, you can decide to put more into RRSP to save the income tax, or you can just max out your TFSA and put it into some investment and enjoy the tax-free growth.
Amazing. And then another follow-up question here is for someone who has never met with a financial advisor before, what does that first meeting usually look like?
The first meeting is usually focused on getting to know uh, you, and not about, like, for example, if, because you come to the bank, I want to sell you something. As an advisor, um, we do our best to ask questions about your current situation. Like, for example, we ask about your income, expenses, savings, and financial goals. And we also take time to explain how the Canadian financial system works, and answer any questions that maybe client have. There's no pressure or commitment in the first meeting. Just the purpose is really to provide clarity, build trust, and help identify next steps so you can make informed financial decisions with confidence.
That's amazing. And yes, that's also part of like maybe why I hesitated to meet with one because I thought like, oh, I have to show up with something, and but I still feel lost in navigating a new financial like environment, which is Canada.
Mhm.
So it's good to know that there's no strings attached upon your first meeting, and you can just like hash out everything that you need to kind of build an idea of what you should be prioritizing, which I mean, someone like you or rather just a Scotiabank advisor would walk you through step by step. So that's comforting. I actually have a question. I'm thinking like from the perspective of someone like new here, or let's say like because I'm basing this off my experience as a student. But if, for example, I transition to getting like my first full-time job in Canada, like what would you say are like the first three financial moves that um, I should prioritize upon getting um, a full-time job? Or what would
So
you say are the first three financial moves that you know tell me to do? Or
Um, so if you move, like if you have the full-time job, with a good income, and like as I said, the most important is like having a plan. The most important is having a plan. Know your short-term goal and long-term goal. Why you are saving? What is your plan? And like based on your goal, then saving in two different vehicle that we already explained about it. It's either tax-free saving account, RRSP or FHSA, and always track your spending and
Mhm.
automated saving. It's really helpful. In Scotiabank, we call it PAC or pre-authorized contribution.
Right. There's another question here. Does age matter? Is there like a required age limit to create an account?
Good question. For checking account, no. There is different accounts for like youth and for those who are 18 and above. They are adult already, but they can have checking account. For the saving account, like for example, something like tax-free saving account, they have to be 18 years and above. So for the youth, you cannot open tax-free saving account, FHSA, those accounts.
For sure. Let's see. What other questions are out there? Thank you so much for explaining that. I, well, being entangled in learning more about the different investment accounts like the FHSA, RSP. I I read somewhere that there's a way to um, leverage both the RRSP, registered retirement savings plan, and the FHSA for someone who's looking to buy their first home. So is there um, because I know, like, I think my understanding from the earlier discussion, but correct me if I'm wrong, the registered retirement savings plan is like you an account that you can tap in for later when you retire. But now I'm learning that you can also pull that out upon
Yeah,
finding
for
your home
sure.
first.
Yes. Register retirement saving plan or RRSP, it's for when you retire, which in Canada, usually retirement age is 65 years old. But when you start saving in that account, put it into some investment, the money grows, and then after 5 years, 10 years, and now you want to buy your first home. So you can withdraw up to 60,000 from that account without any tax, without any extra payment. And then after you bought the property, you have 5 years grace time. You don't need to think about paying back. And then after 5 years, you have 15 years to put back the amount of money that you withdrew from your RRSP, uh, because this is actually your retirement. This is, I always tell them, my clients, that this is like you're getting loan without interest from yourself. So you save the money, but now it's time to buy a home. You take it out and then put it back again. But FHSA, you don't need to put it back. You just save, and then when it's time to buy the property, you take it out, and that's it.
Right. Thanks for clarifying. We have another question here as well. Probably, is it possible to have a head start and open a savings or pension account internationally and start contributing before being physically present in Canada? It's an excellent question.
No.
No, so because I guess like you will have to provide your immigration documents or
Exactly. So in this case, like we don't open any account for foreign people, and even if they are like they have a status like a student or work permit, they have to come to Canada and open it. Some countries, um, like banks, have some relation to, like for example, they open the account. Like for example, Scotia, I know that it was part of that. That for the student, they open from that country, and then when they come to Canada, they come to any branch and verify their IDs or something like that. But very short time from like when they approve their visa to come to Canada, they could open the account there. Unless other than that, no, we cannot open for visitor or for foreign.
for sure. That's good to know. Another question here in the FHSA account, if I choose not to purchase a house, can I withdraw the money without any restrictions or consequences?
Very good question. You can only transfer it to your RRSP. If you want to withdraw, like imagine you max out your RRSP, because RRSP, I didn't explain, this is very like, it's maybe too much for this meeting, but um, RRSP, you can, every year you can contribute 18% of your income from last year. So imagine you already max out your RRSP and you decide not to buy any property. Now your option is only withdraw the money and pay the tax for the amount of money that you didn't pay tax at the time of you contribute. So we cannot call it as a penalty because you already take advantage of not paying tax at the time of you contribute. Um, but if you have RRSP contribution room, you can transfer to your RRSP without any tax implication.
Right. And I'm just like thinking like on the offside here, like you mentioned that FHSA, you can transfer that to your RSP. Is that just the RSP? Like you can't move it around, like let's say to your emergency funds? Or
No,
is there a reason why that's not recommended?
because you have to pay tax.
Mm,
Because when I, like for example, last year I put 8,000 into my FHSA, but then I decided not to buy any property. Now, when I put that 8,000, I didn't pay the tax.
right.
Now, if I decide not to buy any property, either I have to withdraw and pay the tax for that 8,000 that I didn't pay last year, or if I don't want to use it, I just want to decide to put it into my like another account, then I can have the only option to RRSP without any tax.
Right. So it's either just keep it in the account. There's no penalty to just keeping it there. If you have to withdraw it to avoid any tax, paying
Exactly.
taxes on it, either move it to an RSP. But also that just goes to show that I mean, there's different accounts for different reasons. If you, I mean, I'm assuming the last resort would have to be pulling through your FFA, but hopefully there's your savings account or your emergency funds first that you can tap into, where I guess you don't get penalized for pulling those funds because that's meant for those
True.
um, unexpected events. So it's great to see how different accounts have different uses, and it's
Yeah.
definitely something I know that we've discussed it here, but it even at my rate being here for 8 years still requires a bit of a refresher, um, and having someone to like talk to like in person as well.
True.
Um, there's another question here. Same scenario. If I use the money in the FHSA to invest and the returns on investment is above the 40K limit, what happens to the money that is above the limit?
I like that. Very good question. Um, it it's all good. The reason that you have this account to let your money grow, and when we say the limit is only 40,000, means the limit for contribution, the amount of money that you contribute. But if you put it there and after 4 years, 5 years, your money is now 80,000, it's all yours without any tax.
Without any tax. Oh, that's good to know. And so yeah, you can use that money. So it's not just like money that you actually just put in. Like for example, if I had the 8,000, it's not just like okay 8,000 and then that just goes into the abyss. And I know that there's potential to grow it. Like it's not.
Yes, I would like to mention this, that tax-free FHSA RRSP, we call it as a vehicle for investment. You put this money inside or you put it under this account, but then the financial advisor should help you based on your time horizon, based on your objective and the risk tolerance. Then we recommend to put this money into some real investment, which could be stock, mutual fund, GIC, those kind of investment. Then you will see the growth of the money.
Right. That's all good information to have. And yeah, I think we're good for time in terms of the questions. I'm not seeing any new questions come up. But with that, I do want to quickly just tie everything together. Um, Again, like I guess we've already discussed it. Like, what would happen if they were to meet with you today, and what would that discussion look like?
Right.
So thanks for going over that. But also in the next slide, I just wanted to share that there are definitely uh, support and a few easy next steps that you guys can consider. I've also just included the QR code again that you can perhaps take a screenshot of um, for future reference. But the first one is to opt in to Scotiabank's email for budgeting and money tips. All these concepts are, I mean, even in the 1 hour that we have, as substantial as that is, like sometimes we need a refresher, and I like that Scotiabank's able to provide some of these insights in their own newsletter. The second option is that you can book a session with a Scotiabank advisor like Saji for personalized guidance. And of course, if you're thinking about opening your first bank account in Canada, or even if you're just exploring the options out there, I've also just dropped the link to the Scotiabank Start Right program that you can look in at your own time. But yeah, thank you so much, everyone, for tuning in today. And thank you so much, Saji, for being for like helping me untangle some of these concepts and sharing your expertise. I know that our audience has gotten a lot out of this. And yeah, for sure. And for everyone watching, again, thank you so much for your questions as well and for spending the time with us. Again, if you found this helpful, just make sure to subscribe to our channel so that you don't miss out on what's coming next. We talk a lot about finances, settling in Canada, also touch on immigration a lot. So if that's something up your alley, be sure to subscribe. Any final message, Saji, before we go? Like words of wisdom you would want to impart before we wrap up?
For sure. Thank you so much, Rachel, for having me here, and I'm really happy to be here and help newcomers. I was also newcomer one day,
Mhm.
and I know that learning all these new things in Canada, it's not easy, but eventually we all get there. And good luck, everyone, and hope to have a very smooth travel. If you're here, have a good journey.
Awesome. Well, thank you so much, Saji. And again, thank you, everyone. And I guess we'll see you guys in the next video. Cheers now. Bye-bye.
Bye.